Geez, do you think the U.S. government could maybe be taking possession of 100 million ounces of silver? I don't know. Sure seems that way to me. Ask yourself who stood for delivery for 38 million ounces in the last week on COMEX, and who stood for delivery for almost 70 million ounces last month. And is it the federal government? Is it Tesla, Samsung? We already heard how Samsung's gone to Mexico and dealt directly with the mine by buying doré concentrate. And they're doing it now by standing for delivery, which is a completely legal thing to do. And when you have exchanges that rehypothecate, in other words, sell the same contract over and over and over again, creating tons of volume and extra cash and the ability to, in essence, fleece the market because no one stands for delivery. It's like Bernie Madoff. Everyone was happy with Bernie making big monthly checks until they said, but we want our principal back. How China is going directly to Mexico, the number one producer, China's two, and to Peru, the number three producer, and buying all their pre-refined silver in the form of doré and concentrate, paying double what the West will, shipping it back to China. I am looking at a market that is seeing massive, and I mean massive, deliveries, Daryl, into COMEX. To me, first and foremost, above all else, that's really what matters, because what you are witnessing are the most well-informed traders in the world. Forget about the fact that we're seeing billions and billions and billions and billions come into the market, into COMEX every single month, which no one's talking about in the mainstream, which I just don't get. But the people at that level who have that kind of wealth, they're also connected to the information. They're not doing it just for the hell of it. These people are at the highest level of government, at the highest level of finance and of influence. And when we see what amounts to literally billions every single month coming in, to me, that signals not only that the metal itself is probably worth more than the money being used to purchase it, but it also signals to me that it is of physical delivery that is, I guess you could say, there's a fight going on over real delivery demand over paper promises. And I'll give you an example of what I mean. Now, this is what I'm about to tell you is true of everything we've seen every month since a year ago, November, when Trump won the election. But in the month of December, there was 3,706,000 ounces of gold delivered on COMEX. Well, 3,706,000 times, at the time, $4,300 an ounce. Do the math. You're at, $13-14 billion. And how about the 64,730,000 troy ounces of silver stopped and issued and stopped. That's the same thing as delivered. What's 65 million ounces of silver worth at $80 an ounce? And if a mint box of silver maples or eagles weighs 42 pounds, what does 65 million ounces weigh? And at this level, it's not even the money, Daryl, as much as it is the information that is pushing these people to do it. Now, this has gone on again. Here we are in January, and we've seen roughly 6 or 7 days on the delivery month, which is not a major scheduled delivery month, and yet we've already seen in silver almost 7,000 contracts stand for delivery. About pretty damn close to 35 million ounces of silver has already been delivered in January. So between December and January, you have 100 million ounces of silver that has stood for delivery. Now, there's still another 2 weeks left in the January contract, but this has been going on every single month. And I've been screaming about it on a central bank level since 2020. You go back and watch any of the 6,000 videos I did in that time frame, and you will see this has been a primary thesis of mine, that when the most well-funded and well-informed traders on the planet take possession and remove counterparty risk, stand for delivery at these kinds of numbers, which we've never seen this before on COMEX, never. And where is the mainstream media with any journalistic integrity at all? Where is the idiot Jim Cramer? Where are all of these people who are supposedly doing what's right by the people that they're talking to, and instead they're leading them like the sheep to slaughter? This, to me, is all you need to know. Yes, on top of it, the United States government classified silver a critical mineral. Geez, do you think the U.S. government could maybe be taking possession of 100 million ounces of silver? I don't know. Sure seems that way to me. And forget about the fact that the European Union did it a year ago, and forget about the fact that China, everyone talks about them tightening the noose on exports. Well, what people don't really talk about is what they said in November, which is that we are prioritizing silver for domestic needs before anything else. Then they put on the export restrictions, and they're responsible for refining 70% of the world's silver doré. Yeah, things are getting very interesting. But in terms of the noise and the periphery, what else do you need to know? But that the biggest money in the world who knows the information actually probably creates the information, or is real close with those that do, says, yeah, let's stand for possession every month of billions and billions and billions. And shh, don't tell anyone. I have to look over my back and make sure, I don't got someone looking to stab a knife in my shoulder, because I've been saying this for months on end now, and, it's happening and it's accelerating. December was the biggest delivery ever in silver, ever, for a month of December in the history of the COMEX market, which goes back to 1974. So, wow. I don't know, man. Things are starting to get crazy. And when you see these kind of deliveries instead of paper promises, when you see countries standing to change the rules by implementing strategic minerals lists or tightening exports, this is becoming real very quickly. When we started the year 2025, silver went from the mid 20s, low 30s early in the year to upper 70s by year end, and now we're trading at almost 90. This is not, and as far as I'm concerned, this isn't just a gradual rise in the price of silver. This is silver repricing, and gold repricing, which doubled. And I think these things are beginning to happen. And it's because that there has been, for many years, central bank suppression on both gold and silver in the West. Silver for the military-industrial complex, and gold because of Gibson's paradox, the inverse relationship between real interest rates and gold. So they had a vested interest, they being the Western elite, the central banks, in holding these things down. What makes things very different now than at any time I've ever done this is the ability to stand for delivery. And the countries that are doing so prior to whoever's doing it here in the U.S., these were, I think countries that for many years were not sophisticated or coordinated or motivated or had any interest in challenging the West. And they're doing it now by standing for delivery, which is a completely legal thing to do. And when you have exchanges that rehypothecate, in other words, sell the same contract over and over and over again, creating tons of volume and extra cash and the ability to, in essence, fleece the market because no one stands for delivery, it's easy to do. But when everyone says, here's the vulnerability in the entire system and it's about standing for delivery, it's like Bernie Madoff. Everyone was happy with Bernie making big monthly checks until they said, but we want our principal back. And then the whole thing fell apart. Well, it's the same thing here. It's the vulnerability to the Western system that has been exposed by countries that are coordinated and motivated and wealthy and sophisticated that were third world 20 years ago. Now they're not. And this is creating a very, very big problem. Anyone foolish enough to be naked short in this market, I think, deserves what they get. And I honestly believe that we will find that out sooner than later, as some of these banks are hemorrhaging. And there's a report out of the Economic Times that says it's the U.S. banks that are long, and that and they have quietly flip-flopped, leaving the European banks and maybe a bank or two in Canada naked, exposed to what could be an existential threat in the rise of metals prices. Well, I think the public will be last to the party. The industrial demand, I think, will come to some sort of a very large battle with the big funds, the big money that's doing it from an investment standpoint, who will have a very hard time ignoring the gains that we're seeing in these markets that are blowing through all resistance levels and have outperformed everything. So at some point, ask yourself who stood for delivery for 38 million ounces in the last week. on COMEX, and who stood for delivery for almost 70 million ounces last month. And is it the federal government? Is it Tesla, Samsung? We already heard how Samsung's gone to Mexico and dealt directly with the mine by buying doré concentrate. But that's the same thing I've been saying for 2 years now that China's been doing, as I was told by Sean Kuhn, a mutual friend of ours, the CEO of Dolly Varden, and Keith Neumeyer talks about it, how these banks, how China is going directly to Mexico, the number one producer, China's two, and to Peru, the number three producer, and buying all their pre-refined silver in the form of doré concentrate, paying double what the West will, shipping it back to China to refine it.
Retail demand always arrives after supply has already been claimed. Andy Schectman points out that 38 million ounces in a single week and nearly 70 million in a month aren't speculative surges. They reflect procurement. When companies like Samsung bypass open markets to secure concentrate directly, it signals anxiety over future availability, not a chase for higher prices. China's readiness to pay double for pre-refined silver echoes past commodity shortages, moments when securing supply mattered more than protecting margins. For investors, the message is clear. Industrial demand could swamp financial flows far sooner than expected. And what Andy Schectman highlights next explains why that collision could fundamentally reshape how silver is priced.
Well, that's the exact same thing that Samsung is now doing. So you're seeing a situation where at some point the industrials who have to stockpile say, my God, it's going so fast and now everyone's going to buy it. If we don't jump in and take millions of ounces, we could be in big trouble. So you will see the industrials battle I believe, the hedge funds at some point and push the price massively higher. At the same time, now you have the governments involved as a critical mineral and limiting exports. And there are very few commodities that have plurality in use, right? Like you have monetary, you have military, you have industrial and many forms of industrial. And you have all the players in that game that are all saying, well, geez, I need it. And now you have the U.S. government amongst the European Union and now China, the real big boys and girls in the room who are saying, but we need it too. And so between the industrials, the governments, the investors, and then the retail investors who will get the scraps into a depleting pool of availability, where we're now 6 years in a row in a structural imbalance between supply and demand. Only about, 18% of what was mined last year, of the 800 million ounces, only about 160 million of the 800 million came from companies mining silver. That's it.
This is where price discovery stops being polite. Schectman is effectively describing a four-way demand stack. Governments, industry, funds, and retail all competing for a shrinking supply. 6 consecutive years of structural deficit matter far more than any quarterly price chart, especially when only 18% of global silver output comes from primary mines. Byproduct supply can't scale quickly, which means shortages don't respond to higher prices the way oil or copper do. For long-term investors, this creates volatility driven by scarcity, not sentiment. And what Andy Schectman explains next is why latecomers may only be left with what remains.
The rest of it, and less than that, comes from byproduct mining of copper, lead, and zinc. And so, yeah, it's becoming something where demand is massively increasing, hasn't hit the mainstream yet for the retail public, but it's being driven by the highest money in the world at a period of time when we're going deeper and deeper and deeper into an imbalance between supply and demand. Mm-hmm. And it's coming out of the ground at 7-1. In other words, 7 ounces of silver for every 1 ounce of gold, yet it's still priced at upper 50s, 56-1, but it was at 120-1 in March of 2020. It was at 85 or 90-1 most of the last several years. So it's beginning to move back towards not only its historical ratio, and everything always does regress to the mean, regress to the average. How low does it go? Don't know. But if you told me that it would regress into 30-ish to 1 or 20-ish to 1, I mean, that's totally logical and still many times higher than it's being pulled out of the ground at and depleting, disappearing. So you look at all the silver used in military applications and industrial applications, and the military applications have blown up, and the industrial applications, because such a small amount is used, most of it doesn't get recycled. It's in landfills. So it's depleting, it's disappearing, it has multiple uses, and now being challenged by sovereign nations it's, I think, the buy of a generation.
The detail most people overlook is that silver's scarcity problem isn't theoretical. It's mechanical and irreversible. As Andy Schectman notes, silver is mined at roughly a 7-to-1 ratio relative to gold, yet markets continue to price it near 56-to-1, a distortion that defies both geology and real-world usage. We've already seen how violently this imbalance can correct. In 2020, the ratio collapsed from nearly 120-to-1 in a matter of months, instantly revaluing capital for those positioned early. Unlike gold, silver is permanently consumed. Military applications, industrial demand, and sovereign stockpiling destroy supply because most silver is never recycled. This isn't hype, and it isn't a long-term abstraction. It's a structural drain that balance sheets cannot hedge away. What Andy Schectman highlights next explains why this imbalance may not unwind gradually, but instead resolve suddenly and without warning.
The dollar that we think is a good store of value is more like a melting ice cube. And what gold and silver are amazing stores of value. I can show you some numbers very easily. But, you know, first of all, we're told that the dollar was only down 9 or 10% against the dollar index, but that's a very poor measurement because of Triffin's dilemma, which says that countries will always need, you'll run a trade imbalance always if you're the world reserve currency, because countries need to sell their currency to buy ours in the open market. We don't provide them enough dollars through trade alone. They're constantly devaluing their currency against ours, so we're measuring the value of our currency against a basket of crappy currencies that continually devalue against ours. It's a poor measuring stick. Look at gold and silver, and you'll see that the dollar was down 150% against silver and 75 or 80 against gold. But I'm going to give you a good analogy or a good example of what I was talking about. So I'm just going to use my phone here. I'm going to put my glasses on so I can see. Maybe jot these numbers down for me, Daryl.
Yeah, I got you.
So here is the average house price in 2025. The average house price in 2025 is $530,000, okay? The average house price in 2005, 20 years ago, was $232,500. And then if you look at what was the average gold price in 2005, write this down, $445 an ounce. And today, price of gold is $4,600.
The false sense of security comes from comparing a weakening dollar to currencies that are deteriorating even faster, rather than to real assets. As Andy Schectman explains, Triffin's dilemma ensures chronic dilution for any reserve currency issuer, turning the dollar index into a cosmetic benchmark, not a measure of truth. When the dollar has fallen roughly 150% against silver and 75 to 80% against gold, the loss of purchasing power is no longer debatable. Housing prices doubling since 2005 isn't genuine wealth creation. It's currency debasement disguised as appreciation. Investors who focus only on nominal returns risk mistaking inflation for performance, especially as the world enters an era of sustained deficit spending. What Andy Schectman reveals next forces a fundamental rethink of what price growth actually means in real terms.
So, okay, let's do the math. So, what was the average price of a house in 2005?
I was at 232,000.
And what was gold?
445.
All right, so 232 divided by 445 is 521 ounces. So 20 years ago, you're saying to your wife, should we spend the 520 ounces that my grandfather left us and we'll have no debt? We can buy this house outright. It doesn't pay any interest. Or I guess we could stick it under our mattress and earn nothing but dust for 25 years if that's what we really want to do. The mortgage will almost be over by then. We'll own the house free and clear, and hopefully gold goes higher. And you guys decide, yeah, let's do it. So we look at the price of a house today, which has almost doubled in dollar terms. Is that correct?
Yeah, we're at about 535K.
So it's doubled, 232 to so great. You doubled your money and you got your gold. Sounds good, right? Well, it is good because if we take a look at not selling that gold, and what I'm getting at here is that anything that you value as an asset price in dollars looks like it's going way up. It's doubled, over doubled. Measure it in gold and the prices are collapsing because what are 521 ounces of gold worth today times 4,600? You're at almost $2.4 million. which buys you 5 houses at today's prices. 5. And that didn't earn any interest. So what gold is a way to maintain your purchasing power, and in some cases accentuate it. Now you can take any asset you can think of and do this with. Go back to 1971 and you'll even see, since we left the gold standard, that all asset prices are deflating against gold and massively inflating against a falling dollar.
The illusion is that debt fuel gains appear productive when measured in a weakening currency. As Andy Schectman demonstrates using simple housing math, gold preserved and multiplied purchasing power, while dollars merely obscured inflation. 5 homes versus 1 isn't speculation. It's arithmetic shaped by monetary policy. Since 1971, assets didn't surge in value. The denominator collapsed. For long-term investors, this reframes risk entirely. Holding dollars concentrates exposure to policy-driven erosion, while real assets hedge against it without leverage. Portfolio stability isn't about chasing yield. It's about defending purchasing power across cycles. What Schectman connects next explains why this dynamic doesn't stabilize over time. It accelerates.
So in other words, gold didn't go higher, the dollar just keeps falling. And that's built into the system, and it's accelerating. So yes, you own gold not to become wealthy, but because it is wealth that has outlasted 2 world wars and German hyperinflation and the Great Depression and every pandemic and everything. Mentioned cumulatively 700 times or more in the Bible, and here we are 6,000 years later, and what do you know? Things have come not really, well, they have come full circle, and the most well-informed traders in the world are rushing to accumulate it and repatriate it and take possession of it quietly that no one really sees.